Right. Well, hopefully then, fine. Okay. Right. Well, we'll crack on. We'll crack on. If the sound just breaks up and goes completely, then do just put a little note in the box there, and we'll see if we can sort something out there. Manoj, good to see you also in the room. Excellent, and Ben. Right, well, guys, we're going to look first of all at the JAPY, the USD JPY, because what we've actually what we know over the years is that, and it is years now, that the USD JPY, if I whiz this over to a monthly chart, we've seen it collapse since '08. US dollar absolutely collapsing, and that was the start of the crisis. It just collapsed, dropped out of the sky. As we can see, it ran through for just over, 4.75 years for a major move down. Okay, a major move down. Trend line can just pick up the various points, and eventually the trend line broke, and it reversed. Look at that. We've got a reversal month there, which is a standard engulfing candle. Now, the all-important thing is it did the breakout move, and then it came back to test these lows, really to see if there were any real, genuine, strong buyers there. There were, and it took off. And we all know the fundamental story that went on, because as this US dollar collapsed against an ever-strengthening Japanese yen, then the Japanese had a big problem. They found that with their strengthening currency, then it wasn't helping their economy at all. It wasn't helping their exports, which were suddenly, well, not suddenly, over 4 years, then they were getting more and more expensive, and making it really quite difficult to compete. Mohammed, good to see you in the room. Long time no speak. Hope all's well. And they decided to do something about it. So the QE that they had indulged in over a number of years, then they just really pumped it in with trillions of yen. Yeah, okay, yeah, we'll certainly do that, Sharon. Yeah, no problem at all. And they pumped in with massive more amounts of QE. And the interesting thing is that the market rallied up. And I'm just going to put a little bit of Fibonacci on here. And the little bit of Fibonacci that I'm going to do is just a very simple little bit of Fibonacci. And just look how price has moved up through where this white line is, which is a potential resistance zone, and it pushed up really neatly to the 61.8. And so 61.8 then is that all important. It's the golden ratio. It's the key Fibonacci ratio. 50% is not, by the way. In fact, I was listening to somebody who described himself as a Fibonacci expert talking, about the 50% Fibonacci retracement. It is not actually. It's a Gann retracement on its own very pedantic point, but it's not actually a Fibonacci ratio. 61.8 is, and pricing has bounced off it. Now, the fundamental story is telling us now that the Japanese are starting to realize that they have got not just a problem of the amount of money flowing through the economy, but the amount of money flowing through the economy, which is really not enough in order to really sustain their economy, is based on some fundamental demographic factors. And their problem is, and we've known this for years, that they've got an aging population, they have got virtually zero immigration, and consequently, the number of productive people in their economy is just dropping down. There are fewer of them. There are fewer of them. So consequently, the domestic economy needs to be allowed to shrink, but they're not allowing it to shrink. However, that's all by the by. What we've now got on the weekly chart is a little plateau level. And the white line is actually picking that up really, really quite neatly. So remember that white line was a potential resistance line, and it's now acting as a support line. And there's a big but to this. Technically, we could well find that this might even result in a little measured move. Now, a measured move, as you know, is you take a move down, such as that. We've got that dotted line. And then you take whatever the high is and you project it down. And it's suggesting now that price really wants to get itself down to under 100. And I've been waiting for this for a long, long time. And I think it's going to happen. I feel that we're going to get a move down so that this will drop down at least another 150 pips, maybe 200. So that's what the weekly chart is looking at. But we're now going to switch to a chart that actually tells the opposite story, and that is the daily chart. So here we are. We've got this daily chart, and that's all part of that Fibonacci grid that I've been putting on. I'm just going to take that off now because we can't see any lines in here. But you will notice that my automatic WaveR Fib Finder software is picking up a whole series of fibs. What it's picking up this very important white line area, the support zone, where price has so often just popped through and then it's absolutely taken off like a rocket ship. Pops through, rocket ship, pops through, rocket ship, pops through, well, probably not quite a super rocket ship. It did it again just down here and it shot up. Will it do the same again? Well, it might. It just might do that. It might move up 100 pips or so, and still that ultimate target of around about 99.50, 99.60 could still be on the cards. But for the moment, and most recently, and this happened, as you can see, 3 trading days ago on Friday, it hit a Gartley level. And a Gartley pattern is quite a unique little pattern. I guess that most people actually in this room right now will know what a Gartley is. Well, you measure it like this. You take the previous low, the previous high, and you put a line. We're then looking for a measured move. So that would be the first part of the move. This would be the corrective move. And then on down it comes. Now, ideally, there we are. That's the full Gartley pattern in place. So price has to correct on down. It moves on down in the Fibonacci terms. That little corrective area wants to be between 50% and approximately 61.8. It's more or less spot on there. Okay, that's that one. This little move wants to be very similar in terms of correction back to the high. And then the measured move, or the ABC move, ideally wants to come down to 100%. So these legs, these thrust lower legs, need to be exactly the same. They are absolutely identical. So when this presented itself, and just sort of been watching this over the last week, it then presented itself, okay, on Monday, and lo and behold, price moved up. Well, today it's correcting a little bit. Not quite sure whether it's going to move on down or not, but it's showing signs now that it's going to recover. So in the short term, and by that I mean over maybe about the next 4 or 5 trading days, it's entirely possible that we are going to see a reasonable rally in the USD JPY. And this this general rally has got the potential to put on 100 pips into the region of the previous high. Because when you get a Gartley pattern, that is the first target. First target is going to be the region of the previous high, up around there, around about, the 102.50 to 70 region. And beyond there, then what we do a little measurement, again with some Fibonacci. And what we do is that we measure up. There are actually a couple of measures of this, but the basic measure is to then take 161.8. Now that could add on yet another 100 pips on top of that. So there's a little bit of potential for a rally. And what is supporting that then is some Fibonacci. The fact that this price is right now in a support zone, and quite a lot of participants are feeling that the whole QE experiment in Japan has actually run its course and that they may well have to unwind from it. So there we are. Now, how can you get the Gartley chart? Well, we're actually looking at a Gartley chart, and it's really just a question of measuring it, and measuring it with your Fibonacci grid software that is built into pretty well, not every single charting package, but most of them. Now, this is TradeStation. It's got quite a good Fib grid. But what I've actually produced, and this was with Larry Pesavento's help and so on, we programmed this and made quite a few sort of alterations to it so that it actually flags up these levels, and it does it automatically. Once price gets to within around about 5% of the specific spot on level, it flags this up so that we can just see it, and it does it automatically for us. So, but you can get that from me, and you can get it from clickevents.co.uk. It's all part of a Harmonic Wave Trader package at a very modest price, I have to say. So, JP, that's one way of getting hold of it, and I'll pop my email into the box in a minute so you can have a good look at that and make your decision accordingly. So let's come down in the time frames, and the time frames now on the 240 minute is showing that this is once again picking up some of these Fibonacci harmonic levels. Okay, all explained in the package. I've sort of gone to tell you. But it's got a really important candle. And that important candle, let's just put a little space now between the candles. We can see that on Monday, that was the low, picked up the harmonic level. It is a candle which has got a body, and it's got tails on either side. So it's a spinning top, but it is also a bullish engulfing, meaning that it opened lower, it closed higher than it opened, and it completely engulfed the preceding candle. And then later on Monday, we get a nice little Hallmey. This candle attempted to move lower, but lo and behold, there were buyers there, and they pushed it up. They pushed it up really quite smartly, and as we could see yesterday, there was quite a strong move. Now, the question today is this going to put a bottom in here at 101.40? This current candle needs to run through for just over another hour and a half. If this candle completes, and it completes with a long tail, showing that there are buyers in there, despite the small number of sellers, then it's possible that we may well have seen the bottom today, and it could be ready to move on. So that's a possible market that I'm looking pretty closely at, and it's got the potential to run up 100 to 200 pips or so. Once it reaches that level, then I'll be looking to sell it right away back down again. Right. let's move on, look at something else. And I think, well, yeah, let's, Sharon, we'll go straight to the Australian, because that is a very interesting chart itself. Excuse me, half a moment. And here we are. Let's go to the daily. Let's go to the daily. In fact, let's do the same that we did with the Jappy and go out to the monthly first of all. Right. We can go right the way back to 08. And just look at this. The big crash, we saw the Australian dollar move down, and it moved down over, well, 1, 2, 3 months. But then it recovered strongly, poised, got above the previous high, and on up it went really quite dramatically. It went through the parity level, that 1-to-1 with the US dollar, and it got it to 1.1. Since then, it's crashed on down. And of course, the fundamental story there was that the Australian economy is totally dependent upon the Chinese economy. And as the Chinese economy was said to be getting itself overheated, and the fact that they built far too many roads, far too many cities without any people actually moving into properties, etc., then they would no longer be buying aggregates, etc., out of Australia. And of course, that was the fundamental story then that pushed this move on down from this little trading range. And lo and behold, where did it move down to? Well, it moved down to a very important level. If I put the Fibonacci grid on, lo and behold, we get yet another one of these 78.6s. That is the Gartley level. That's the Gartley level. So it popped down to there. We could actually just put a second grid on and run that up to a high, and, well, didn't quite make the 50% level. Didn't quite make the 50% GAN level. But the significant thing is that it hit that 78.6 level. It did that, and it did it in January, well, nearly February. And since then, it's been moving up. Well, let's work down the time frames again, down to the weekly. Let's go to the weekly. There we are. And what we can see then is that this actually did put in a 5-wave move. Now, with Fibonacci, Elliott wave, and so on, then we can see that this was a very, very clear 5-waver on the way down. So we've got a wave 1, and then we've got a wave 2, which is the corrective wave. And then we've got a long wave 3. And we've got a wave 4 that did a bit of a bounce up. And then we've got a wave 5. Now, wave 5 is very often the same length or less than wave 1, and it was actually less than the length of wave 1. But look at that, how it turned on a sixpence. Well, it actually turned on a Hallmey break. Okay. Inside bar, price moved higher. Then we get an engulfing. So we've got several weeks there that are telling us that it was going to move on. We get yet another one just there. And every time we get this little correction, we then get a very, very clear buying signal. So over to the daily. And the daily then is just showing us that we're really moving on here. And there is a possibility that we will see somewhat higher levels within this current trend, So where it is right now at 95, that is a significant level. What I'm a little bit concerned about is that we've got a false break reversal level being flagged up by the software, 112.8. And so as this market is well and truly overextended at a round number, And at this time in the week, where we're now middle of the week, we're now the middle of the week, start of the new month, at a round number, I would be a little bit cautious about the next 3 days. We want to be just a little bit cautious there on the next 3 days. So the Australian dollar, which is generally a pretty good Fibonacci market, has been showing us here that we've got bullish candles at these lows. Bullish candle, very bullish candle, very bullish engulfing candle, and the uptrend is continuing, certainly for the moment. Certainly for the moment. Now, if we come down much shorter term, then if we just take a little glance at what is going on here with the hourly chart, then over last night, picked up a high as a crab level, so suggesting there's going to be a correction we've actually got, and it's entirely possible that this correction is not all finished yet. It could want to come further down. It could want to put in a measured move, so it's entirely possible that this could drop into this zone of 94.40 to 94.20. Now, just a small point about these colored candles. These are the extreme activity candles, and they color the particular bars based on the amount of volume activity that there is going on. And as you can see on this move down, we've got these sort of strong red candles, which are pushing price lower. But then we get a succession of lower volume activity candles, which happen to pick up at a 50% level. And it's telling us that there is likely to be, at the very least, a pause. There might even be a snapback. Now, there was a little mini snapback with a couple of reds there, a couple of high volume activity. But then we've got 1, 2 candles, which are thrusting lower candles because they've got a long upside tail. And then we've got a couple of blues. And we've now currently got a blue, which, well, it's only just started. But these blue candles are showing that there is not a great deal of activity in here. And so we're just at a pausing level. But they're all suggesting that just maybe we should expect another leg down. Now, that may or may not come to pass, but if it were to do that, and we could then see a very clear measured move, one of those A, B, C moves, then price were to get itself down into this zone of prior price action, we just might be wanting to look for a reversal somewhat there. Right. Okay, guys. John, to some extent, I would agree with that comment, that it has been less reliable, certainly less reliable than it has in the past. Right. Let's move over to the euro. Right. Well, let us again do the macro to micro look. Run this out to the monthly. Whole series of lines here, but effectively, what we're looking at, I'll just move some of these lines. We can say that we've got a level there of, well, which is sort of 121, but just above the 120 level. 2, we could take it up to the 145 level, is the trading range. And the way that price is attempting to move higher, will it actually go that much further up to that 144, 145 level? Well, it's entirely possible that it will. We've got a little bit of a blip. This is a monthly chart, bear in mind. This is, well, we're only 2 days into the new month, so we've just got a tiny red dot. Last month, though, we've actually got a bullish month. It went lower and then it went higher. But then if we go back to May, it engulfed on the downside. But the trend is still up. Bullish month last month, so it's entirely possible that this will continue. we will go and take a little glance at the dollar index, because the dollar index is going to be one of the determining factors as to what is actually going to happen here with this euro. So let's now bring this down in the time frames. Let's go to the weekly. The weekly then is showing us that we've got this engulfing that pushed price on down, but then we get a neat little Hallmey week, and what you can just about see on this is that we've actually now got a Hallmey break, okay, a bullish Hallmey break. Down to the daily, and let's look at this in just a tad more detail. What we're now seeing is that we've got a reversal down here. We've actually got a bullish reversal at the region of the previous low. If I just move this around a bit, we've also got a couple of harmonics picking up. We've got a 70.7 level, we've got a 38.2% level, with absolutely the right candle, showing us that that was a significant level, significant reversal. We so often get this, that is the breakout candle, okay, that's the breakout candle. We then get a deep correction, but it did not go below the low tail of that hammer engulfing. Price then moved up, as we can see, and it's been moving up and up and up and up. A little bit of a hiccup because price action on Monday was quite dramatic. It pushed up above that previous high. And on that previous little downtrend, it was the last lower high. Price moved up above there. And the interesting thing is going to be where it picks up some support. Now, this one could correct back. It could quite easily correct back to 136 or even lower before then moving higher and having a go at getting up to that 140 level. So the uptrend is intact. Longer term, it looks that it's probably got more in it. Short term, it looks as if it needs to correct back somewhat further. So there we go. Just might want to come back towards the round number there at 136. Now, what about the fundamental situation with the euro? Things ain't what they used to be, and well, I mean, that's a real, yeah, absolutely, Sean. It's going to be, an interesting day. In fact, we just need to be aware that Friday is the 4th of July. And, of course, the 4th of July is Independence Day in the States. And so this Friday is going to be a little bit different to the first Friday of most months. So, yeah, we're going to have to look at what the non-farm payrolls are going to be doing. Absolutely, yeah. So what we're going to be really, really careful and be aware of the fact that the ECB really do want a much, much lower euro. But the market has decided that it wants a higher euro. And so there's a real tug of war going on. And that tug of war right now is being won by the market. The ECB is not getting what they want. So which is going to be the more powerful? Well, I think the market is actually now looking at not what it used to look at, which is just purely interest rate differentials. The market always used to be fixated on that. But what is now coming into the equation is very much more based on how sound the relative economies are. The US economy, which keeps telling us that it's growing, is pushing out all sorts of things. And the real strong story that US growth is actually really coming through is starting to look a little bit paper thin. And the markets, I I feel, are now starting to focus on such things as the trade balance. Now, the trade balance of imports against exports in Europe overall is actually not too bad. But in the US, it is abysmal. It's abysmal. And they can only run a massive deficit because of the worldwide demand for US dollars. But if there's a general slowdown, and if these stories that we hear about the Chinese doing deals on gas with and oil with the Russians bypassing the US dollar to be believed, then just maybe we're going to get a major shift coming out of what is going on with the US dollar. So the US dollar, it's entirely possible, could well work lower. However, as you say, Sharon, it could all change this week. We've got a really interesting week, and we've just got to wait and see what is going to be going on. Right, now, we will just look briefly then at this weekly chart, this hourly chart, 1 hour chart. And what this is telling us is that from yesterday, 137, it's not going to see it. Chances are it wants to move lower. We've just got 1 or 2, 3 blue candles so far, which are telling us that the volume activity is much reduced. So this rally hasn't got a great deal of steam in it. And so I wouldn't be at all surprised that we'll see it just roll over, and we could get a break lower, even below that 38.2%. So there we are. Right. Okay, guys. Well, we've looked at 1 or 2 of those. And I suppose that what we really should be looking at is the opposite side of that coin for a moment. Let's just take a brief look at the dollar index. As you know, the dollar index, it's a tradable contract. It's made up of a basket of currencies, of which the euro is the largest component. It's been bouncing off harmonic levels and Fibonacci levels. Bounced off a bat level, price moved up, came on back down, picked up on a previous low, happened also to be a butterfly level, shot up, reached an equal and opposite level where it bounced off the bat level, off the butterfly level, engulfing, correction back, and then you can see it's just moved on down to a support zone, 61.8, and absolutely, that's exactly what it's telling us right now. 61.8. Also, the software yesterday was telling me that this was a false break reversal level. It's actually got ever so slightly below that, but it is still a false break below that previous low. Markets do this very, very often. In fact, we just put the independent grid on. And what we can see then is that there's a strong possibility then after those big down days that we may well get a very useful little rally on this one. But will this then result into a further leg down? We could see this as being a wave 1, a wave 2, a nice long wave 3. We could now be looking for a rally back that just might roll over and then put in a test for this all-important 79 level. Anyway, that's in the area of speculation at the moment, and it's looking very much as if we've got another, well, I think we can squeeze another sort of 5 minutes or so. So let's now go take a look at okay, right, where are we? Here we are. Now, this is a really interesting market. Predominantly, we've been long at this for quite some period of time because it's got the fundamental story behind it. we have got a growing population. And the reasons for that growing population is that we have got lots of people who want to come to the UK and they want to work. And when you've got a growing population, then it boosts an economy. Plus, our Chancellor appears to have sort of worked quite a useful little trick, and we've got growth coming through. So, the inference being is that we are going to see rising interest rates rising further and faster than any other economy. Consequently, then we've got an influx of money into cable. Where is it going to go from here? Well, we've got this trading range that ran since the crisis, and we've now got a breakout above the top of the trading range. Where could it go? Well, in the short term, I've got a target of 173. Longer term, it just might decide that it's going to get itself above 180. And highly possible it might even want to go somewhat further than that. But we've got certainly a very, very strong uptrend. Now, if you just look at this on the weekly chart, I've put a little bit of Fibonacci in here, and just by basing this on the move that we've had running up from the low, a little correction, and then price moves on, it's telling us that we could well get a move that will take us to, well, absolutely spot on is 172.71. But I reckon that's going to be the round number at 173 as quite, I think, a reasonable projection to actually go for with this current move, before we get any really, really significant correction coming through. So flavor of the month looks like it wants to keep moving on. The daily chart, okay, the daily chart is just getting a little concerning. We've had this actually hit a crab level, but price seems to want to keep moving on. This crab level was actually hit during yesterday. It's pushed above this round number, so the uptrend does appear to be well and truly intact, and I guess that we've just got to stay with that for the moment. But where you've got a market which is clearly overextended, and we can do a little measure on this by just looking back to the weekly for a moment and looking at this little number. This little number tells us how extended on the week it is, and it's just gone above 105% of an average weekly move. So if Sharon is right, and we'll start to see the dollar strengthening into the end of the week, we could well find a correction here. So we would want to be very, very, very cautious indeed about wanting to jump onto this move, which by any measure, it is well and truly stretched. If we've got longs on from weeks and probably several months ago, then absolutely fine. Maybe we can hold those and be very careful to preserve our profits. But I would be very circumspect about wanting to take further longs on it right now, despite the fact we have had one or two quite reasonable rallies. Now, in terms of breakfast trades, we've had some quite reasonable moves. We've had some 9:30 news-based moves, which have really sort of pushed things higher. But the charts, short-term, just at the moment, are telling us to be very, very cautious indeed. Right, guys, come to the end of really what I wanted to cover. If you've got any questions, do want the questions out. But if you want to talk to me any further about any of the software, any of the programs that we do, etc., then don't hesitate. Personal email is just about to come up. George@clickevents.co.uk. There we go. And be only too pleased to take things a stage further with you. But for now, enjoy the sunshine if you're in the UK, and also let's just see how this week does finalise, particularly with what goes on with the NFP. Bye for now.